What if I told you that one of the biggest shifts in the stock market didn't come from Wall Street veterans, but from an app on your phone? A platform that removed trading fees completely and attracted millions of new investors almost overnight. It sounds like a win for the average person. No commissions, no barriers, just open access to the market. But here's the real question. If trading is free, how is the company making money? In this video, we're going to break down why Robinhood made trading free, how that decision changed the entire financial industry, and most importantly, how they actually profit behind the scenes. Because while it looks simple on the surface, there's a system working in the background that most people don't fully understand. By the end of this video, you'll not only understand the strategy behind commission-free trading, but you'll also see the business model that made it possible. The problem with traditional trading. Before platforms like Robinhood entered the market, investing wasn't as accessible as it is today. If you wanted to buy or sell stocks, you had to go through traditional brokers. These brokers charged fees for every transaction, sometimes ranging from $5 to $10 per trade, or even more depending on the service. For large investors, these fees were just a small cost of doing business. But for beginners or small investors, they were a major barrier. Imagine trying to invest a small amount of money and losing a portion of it immediately just because of fees. It discouraged people from participating in the market. This created a system where investing felt exclusive. It favored those with more capital and more experience, while everyday people stayed on the sidelines. The process itself was also more complicated, with outdated platforms and limited user-friendly tools. This is the environment that Robinhood entered. Instead of following the traditional model, they asked a simple but powerful question. What if trading didn't cost anything at all? The idea behind free trading. When Robinhood launched, their main goal was to remove barriers and make investing accessible to everyone. Their approach was simple. No commission fees, a clean mobile interface, and an easy onboarding process. This idea alone was enough to disrupt the industry. Suddenly, people who had never invested before could start with small amounts of money. The psychological barrier was gone. You no longer had to worry about losing money on fees before even making a profit. The simplicity of the app also played a huge role. Instead of complex charts and overwhelming data, users were presented with a clean and intuitive experience. This made investing feel less intimidating and more approachable. As more users joined, the platform grew rapidly. And it didn't take long before other major brokerages were forced to respond. Companies that had been charging fees for years suddenly dropped their commissions to zero as well. What started as one company's strategy became an industry-wide shift. But this leads us to the key question. If no one is paying trading fees anymore, where is the money coming from? Payment for order flow explained. The primary way Robinhood makes money is through something called payment for order flow. It might sound complicated, but the idea is actually simple once you break it down. When you place a trade on the app, your order doesn't go directly to the stock market. Instead, it is sent to large financial firms known as market makers. These firms execute your trade, and in return, they pay Robinhood for sending them that order. Why would they do this? Because market makers make money from the small difference between buying and selling prices, known as the spread. Even tiny differences can add up when millions of trades are happening every day. So, every time you buy or sell a stock, Robinhood earns a small amount from the market maker handling your trade. Individually, it might seem like very little, but at scale, it becomes a significant source of revenue. This model allows Robinhood to offer commission-free trading while still generating income. Instead of charging the user directly, they earn from the flow of transactions happening on the platform. Additional revenue streams. While payment for order flow is a major part of their business, it's not the only way Robinhood makes money. Like most modern platforms, they have multiple revenue streams working together. One of these is premium subscriptions. Users can pay for advanced features such as margin trading, larger instant deposits, and access to additional tools. This creates a steady source of recurring income. Another source is interest on uninvested cash. When users keep money in their accounts without investing it, Robinhood can earn interest on those funds. It's similar to how banks use deposited money to generate revenue. They also earn from margin lending. When users borrow money to trade, they pay interest on that borrowed amount. This becomes another consistent revenue stream for the company. Together, these methods create a diversified business model that doesn't rely solely on one source of income. The growth strategy behind it. The decision to remove trading fees wasn't just about helping users. It was a strategic move to attract a massive number of customers quickly. By making the platform free and easy to use, Robinhood lowered the entry barrier and encouraged more people to join. As the user base grew, so did the number of trades happening on the platform. More trades meant more revenue from payment for order flow. This created a powerful cycle. More users led to more activity, which led to more profit. The company focused heavily on user experience and simplicity. This made it especially appealing to younger audiences and first-time investors. Instead of feeling like a complex financial tool, the app felt modern and accessible. This growth strategy allowed Robinhood to scale rapidly and become one of the most recognizable names in retail investing. The controversies and risks. While the model has been successful, it hasn't been without criticism. Payment for order flow has raised concerns about whether users are always getting the best possible price for their trades. Some critics argue that routing orders through market makers could create conflicts of interest. Others believe that the simplicity of the platform might encourage excessive trading, especially among inexperienced users. There have also been discussions about transparency and how much users understand about the system behind their trades. While everything is disclosed, not everyone takes the time to learn how it works. These concerns highlight an important point. Just because something is free doesn't mean there are no trade-offs. Understanding the system helps you make more informed decisions as an investor. Robinhood didn't just remove trading fees. They changed the entire perception of investing. By making trading free and accessible, they opened the door for millions of people to enter the market. But behind that simplicity is a business model built on volume, technology, and alternative revenue streams. Instead of charging users directly, they found ways to earn from the activity happening on the platform. The key takeaway is this: free doesn't always mean free. It means the cost is coming from somewhere else. When you understand how the system works, you gain an advantage. You're no longer just using the platform. You're aware of how it operates. And in a world where financial tools are becoming more accessible, that knowledge can make all the difference. If you want more simple breakdowns of how money, business, and modern platforms really work, make sure to subscribe and stay connected.